Welcome back to the deep dive. So, you handed us this fascinating stack of sources, and they're all focused on what really feels like the holy grail of modern finance.
It really does.
How to earn this. Just eye-popping passive income in crypto. And then the really crucial part, how to immediately use that income for, seamless, global, everyday spending. So, our mission today is to really unpack that synergy. We're trying to connect two really different worlds.
Radically different.
Yeah, you have the high-yield, decentralized world of stablecoin farming on one side.
And then the regulated real-world payment system on the other, where you can just spend it anywhere on a Visa or a MasterCard.
The full loop.
It is the full financial loop. And the claims in the material we're looking at are, frankly, magnetic. I mean, they explicitly contrast the traditional bunk offering, maybe 0.5% interest,
Maybe.
against DeFi protocols that are advertising potential rates of 20% APY on stablecoins. But, just earning it isn't the whole story.
Not at all.
We also have to look at the payment solutions designed to make sure that that money, once you've earned it, is actually usable instantly across, 180 countries.
Okay, let's unpack this. And I think we have to start with the biggest number, the one that jumps off the page, that incredible passive income claim. So the sources, they dive straight into this world of stablecoin yield farming, and they're targeting returns up to 20% APY. And this isn't just the theory, right? One of the documents lays out a whole step-by-step hypothetical. It shows you how depositing even just $1,000 could translate into pretty substantial monthly income.
And that 20% number, it's designed to grab your attention. It's meant to shock you, especially when you put it next to your, inflation-eaten bank account.
Right.
And the source positions this 2026 strategy as low risk. But wait a second, 20% APY is only low risk in the context of DeFi. So how do they even begin to justify calling that low risk?
That is the critical question. I mean, for you listening, that's what we have to answer. What safeguards are even implied here that make this different from just high-risk crypto gambling?
And this is where the core framework in the sources is actually really helpful. They make this very clear distinction between protocols that generate real yield and those that rely on what they call inflationary token farming. And that distinction, that's everything. It's the difference between a sustainable income and, well, a high-stakes gamble.
Explain that. What is real yield versus this inflationary farming?
So real yield, that's when the returns come from actual economic activity. Think fees from a lending protocol or interest paid by actual borrowers or trading commissions.
So business is actually making money.
Exactly. You're betting on the business model being successful and generating real revenue. Now, inflationary token farming, that's different. That's when the protocol just issues new tokens, often rapidly depreciating ones, to pay you your yield.
So it's just printing money to pay the interest.
It's diluting the token's value over time. It's almost always unsustainable, and it's definitely a lot riskier.
So if you're aiming for that sustainable passive income, you want a system where the yield is coming from real economic friction, the system itself making money, not just creating it out of thin air.
Precisely. You are betting on business success, not just token inflation. And that's really the only thing that justifies using the term low risk when you're talking about these kinds of DeFi returns.
That's a perfect transition, actually. So we've figured out how one might earn sustainably with a real yield protocol, but what good is a pile of stablecoins if that wealth is just locked up?
Or if it's just really hard to use.
Exactly. And that massive problem brings us to the next part of our sources. The global payment barrier.
Yeah, that's the real-world friction, right? The PintoPay source highlights this huge gap in global payments. They estimate billions of people face just massive restrictions trying to move money.
Think about what that actually means. You've got limited banking access in some places. You have sanctions making transfers complicated.
Not to mention the crazy high fees and just how slow the old legacy banking systems are.
So if you're a digital nomad in, say, Bali, and you need to pay a supplier in Poland.
Forget it. That transfer takes days. It goes through multiple middlemen, and it costs an arm and a leg in fees. This new system is trying to make that feel exactly like tapping your card for a coffee.
Right. And even with crypto adoption growing so fast, the ability for an individual or a merchant or even another fintech company to just spend that crypto easily, It's still really hard.
It's frustratingly difficult.
Uh-huh.
And that's the problem these solutions are trying to fix.
And the demand for this is just, it's exploding.
Yeah.
The sources show a market that is desperate for a fix. I mean, cashless transactions are growing at something like 15% a year.
It's huge.
And instant payments are projected to hit 22% adoption by 2028. Digital wallet use is already, it's over 4.3 billion users. The system is changing. The money just needs to be able to move on it.
The demand is undeniable, which is why a solution like PintoPay becomes so central to this whole idea. It's the bridge that makes that 20% APY actually useful in the real world.
So let's focus on them. The sources frame PintoPay with this motto: no limits, no borders, your crypto anywhere. What did you find in the analysis about how they actually do that? How do they get over that barrier?
Well, the key insight is that they're not trying to reinvent the wheel. They're not building totally new payment rails. They get their utility by integrating very, very deeply into the existing regulated infrastructure.
Okay.
The sources really emphasize this. PintoPay is a regulated provider. They are listed as a Visa Principal member and a MasterCard member.
So what does that actually mean, Visa Principal member? Like, for someone listening, what's the takeaway?
It means they cut out the middleman. They don't need a partner bank to issue their cards. They operate directly on the Visa network.
Ah, okay.
And that status gives them direct support for issuing physical cards, virtual cards. It's why they can integrate things like Apple Pay and Google Pay so easily.
Yeah.
It gives them direct control, which is how they can make their crypto conversions truly instant.
And it gives them access to, what, 30 million merchants globally?
Instantly.
Instantly. So they're basically riding the existing rails, but they're using crypto as the fuel. But wait, if they're on those same rails, aren't they subject to the same old speed limits and fees?
That's where their tech comes in. It's really two things. First, the required KYC, the Know Your Customer checks, that just makes sure they're compliant everywhere.
The regulatory piece.
Right. But second, and this is the most critical part, is their instant crypto to fiat conversion engine. So you tap your card.
At a store.
Yeah, anywhere. The system, in milliseconds, sells the crypto asset and settles with the merchant in whatever local currency they need. The merchant never even knows crypto was involved. That speed is everything.
And beyond just the card for you and me, the sources show they have this whole B2B side of things, an API gateway, and something called white label solution. When you say white label, are we talking about PintoPay providing the plumbing so that some other bank could just launch its own crypto card almost overnight?
That is exactly right. And that, I think, is where the major infrastructure play is. Think of them as like the Amazon Web Services for crypto cards.
Yeah, I like that analogy.
They did all the hard work. They built the regulated infrastructure, got the principal memberships, engineered the conversion engine. So another company, say a regional crypto bank, doesn't have to spend years and millions building that themselves.
They just plug into the PintoPay APIs.
And launch their own branded card product immediately.
So the business is much bigger than just a consumer app. You've got the mobile app for individuals, the cards for spending, but the API gateway and white label stuff, they're selling the rails to other financial companies.
Yes. On the B2C side, you have travelers, crypto traders, digital nomads. But the B2B side is targeting banks, other fintechs, corporate payment solutions. They are, at their core, an infrastructure provider.
Which leads us perfectly into the traction and the financials in the sources. How does an infrastructure model like that actually make money? And what kind of adoption are they seeing?
So the revenue model is pretty diverse. They get money from standard card fees, issuance, activation, that sort of thing. Then there's transaction commission sharing on every payment.
Standard stuff.
But the real long-term high-value revenue comes from those white label setup fees and the recurring maintenance charges for those B2B partners who are using their system.
And the traction.
It's strong. They have over 100,000 community members, selling more than 1,300 cards a month. But the real proof of the model is in the partners they've acquired with that white label service.
Okay, let's talk about those partners, because the sources get really specific here, which is great.
Yeah, they cite three big ones, and they're pretty critical pieces of evidence. First, you have a Wallet Finance. They have over 410,000 users, and they're projecting over $27 million in income using the solution.
Wow.
Second is Crypto Bank, with 320,000 users and a forecast of over $17 million. And then there's CryptoSpace, which uses the system to issue cards directly inside the Telegram app. They have 470,000 users and are forecasting over $30 million.
So the takeaway here isn't just the user numbers, it's that these partners, a wallet and crypto bank, they're already established financial players. The
Exactly.
fact that they're choosing to buy PintoPay's API instead of building it themselves, that validates the entire infrastructure model.
It does. They don't want to build it. They want to buy the plug-and-play solution.
Yeah.
And that momentum feeds into some really aggressive financial projections.
Yeah?
By 2028, the target is 1.2 million clients across all of these channels, leading to a projected $35 million in revenue. And that's a forecast built on the strength of that B2B model.
So what does this all mean? When you zoom out, how does a company like PintoPay stack up against, the giants like Wise or other competitors like Revolut and RitoPay?
The sources actually give us a pretty good framework for that comparison.
Yeah.
If you look at Wise, it's fantastic for fiat transfers, but it doesn't do native instant crypto to fiat conversion. And it doesn't offer white label infrastructure.
So it solves a different problem.
A different but related problem.
Yeah.
And then you have competitors like Revolut and RitoPay who do offer consumer crypto services. But the sources suggest you should ask 3 key questions.
Okay.
1, does the competitor offer instant crypto to fiat conversion? 2, do they have white label solutions for other businesses? And 3, do they integrate Apple and Google Pay?
And it's that combination of all 3.
It's that trifecta, the combination of instant consumer utility with that scalable B2B infrastructure. That's what gives them a distinct position in the market, especially for institutions that want to launch their own crypto-friendly cards quickly and compliantly.
This deep dive has really connected 2 completely separate worlds for us. We started off in this high-return, decentralized space looking at how real yield can generate wealth your bank just can't touch.
Right.
And then we immediately bridged that wealth to real-world regulated utility, with companies like PintoPay solving that global spending problem by just riding the rails that already exist.
And I think the key takeaway for you, the learner, is to recognize that the future of finance isn't really about one world or the other. It's about this intersection.
The bridge.
It's the bridge. The highest value gets unlocked when you can seamlessly connect the efficiency and returns of DeFi with the secure, regulated, and instantly available infrastructure of fintech. You really do need both. And building on that, if we look at the source materials focus on these B2B white label solutions and those huge growth projections, it leaves you with a question.
Okay.
If these payment providers are focused on enabling other major fintechs like a wallet and crypto bank to issue their own crypto cards, does the real competition lie? Not in which consumer app wins,
But in who owns the plumbing?
but in who owns the infrastructure API that everyone else just plugs into for the next generation of global financial services.
That is definitely something to mull over. The infrastructure layer is so often where the quiet, long-term winners are made. They just control the flow for everybody else.
Exactly.
Well, thank you for diving deep with us into the sources today. We hope you feel thoroughly informed and ready for your next decision.